Good morning students, welcome back in our online classes. Today we are going to start this chapter with a new point, the insurance services. Known as the insurance. What is insurance? Insurance, it is just an assurance which gives the people it will be always with you till the end of the life. Insurance is a contract between the insurers and the insured, in which insurer agrees to make goods the loss of the insured on happening of an event in considerations of a regular payment. This agreement is a contract in writing and is known as the insurance policy. Insurance is the device by which the loss likely to be caused by an uncertain event is spread over a number of persons who are exposed to it and who prepare to insure themselves. It provides the insurance service with an agreement known as the insurance policy. How does the insurance work? See, the function of insurance: providing the certainty, the protections, the risk sharing, and the assets in the capital formations. Providing certainty in what the case is the individual or the firm known as the insurance company which agrees to compensate the loss of insured. That protections, actually under the protections, it ensures to the individual or firm who get compensations of loss insured pays a regular amount of premium. Risk sharing, it refers to a subject matter of policy or the kind of losses covered under the policy. For example, in fire insurance, the loss is compensated only if it is due to fire. Assets in the capital formations, it refers to an amount paid quarterly, half-yearly or annually by the insured to insurer for getting compensation at the time of loss. That we talk about the principle of insurance. What is the principle of insurance? It is actually on the with the few point. The principle of insurance of utmost good faith. What is this? According to this principle, insurance is a contract based on faith. The insured and the insurer must disclose all the material fact to each other, and both the parties should not hide any fact related to the insurance policy from each other. If the insured hides any material fact from the insurance company and later on the insurer comes to know about it, then he can refuse to pay compensation. Failure to make disclosure of material fact by the insured makes the contract of insurance voidable at the discretion of the insurer. For example, if a person has taken a life insurance policy, listen properly. If person has taken a life insurance properly, if he has hide the fact that he has a heart patient and later on if the insured dies of heart attack, then the insurance company can refuse to pay compensation because a material fact was hidden by the insured. Similarly, if a factory owner takes a fire insurance and he is hiding the fact that the electricity board has assured him a statutory warning letter to get this factory writing change, and later on if the factory catches fire due to short circuit of wiring, then the insurance company can refuse to pay the compensation because insured has hidden the fact about the statutory warning from the insurance company. The insurable interest, according to this principle, the insured must have an insurable interest in the subject matter of insurance policy. Without interest taking, an insurance policy is a gamble and fraudulent activity, and law does not permit it. In case of life insurance is insurable, interest comes the relations of the insured with the policy taking the insurance policy. For example, if a person take life insurance policy for his spouse means wife, or for his or her children, but they cannot take insurance policy for a stranger. In case of fire insurance, the insured must suffer a financial loss if the subject matter is damaged to prove the interest or he must be the owner of the subject matter. Suppose if a person has taken the loan against the security of factory premises, then the lender can take fire insurance of that factory without being the owner of the factory, because he has a financial interest in the factory premises. But in the case of life insurance policy, the interest must be present at the time of taking the policy. What is the indemnity? Indemnity, known as security or protection against loss. According to this principle, insurance is not a contract of making profit. The purpose of the insurance is to bring back the insured in the same financial position as he was before the loss. For example, a person insured his factory for 2 lakh rupees against fire. Due to the fire, he suffered a loss of 1 lakh. Then the insurance company will compensate him only 1 lakh rupees, not the policy amount, that is 2 lakh, because the purpose of insurance is to compensate for loss, not for earning profit. That is called for indemnity. The proximate cause. According to this principle, the cause or reason for the loss must be related to the subject matter of the insurance contract. If the loss is due to some other cause, then the insurer can deny to pay the compensation. For example, if a person has taken marine insurance policy for sending the wheat bag, and on the way, if a rat is spoiled the wheat, then no compensation will be given, because under marine insurance, insurance can cause the loss should be sea perils and not the rat. On the other hand, if the rat makes a hole in the ship through which water enters and spoils the wheat bag, then the compensation will be given, because the loss of wheat due to the sea water. What is the subrogation under this method? According to this principle, after paying the compensation, the insurer steps into the shoe of the insured. In other words, when the insured is compensated for the loss or damage to the property insured by her or him, the right of the ownership of such property passes on to the insurer. This is also a corollary to principle of indemnity. Indemnity means protection against the loss, because when the compensation is given later on, if insured realizes some money by sale of damaged property, that will bring profit for him, and insurance is not contract for making profit. Suppose if a person has taken a fire insurance policy for his factory, due to fire he suffered a loss of rupees 1 lakh rupees, and he gets compensation for the same. Later on has burned goods were sold about 10,000. Then these 10,000 will be kept for insurance company and not by insured, because insured has already got full compensation for the loss. The contribution. The principle of contribution is corollary of the principle of the indemnity. According to the principle, if a person has taken more than one insurance policy for the same subject matter, then all the insurance will contribute the same amount of the loss. Suppose if a person get his house insured against fire 1 lakh rupees with the insurer, and 50,000 for the insurer B, and A loss of 75,000 occurred, then A is liable to pay 50,000, B is liable to pay 25,000, because total insurance is about only 75,000. About the mitigations. According to this principle, the insured must take care of his property or subject matter of insurance in the same way as he would take care of without taking the insurance policy. The insured should not become careless of his property after taking insurance policy. It is the duty of insured to make a reasonable effort and take all available precautions to save the insured property. For example, if a person has taken the fire insurance policy for his house, when fire breaks out, he should take all the measures to stop the fire and minimize the loss rather than watching the fire, because he will get compensation for the insurance company. Types of the insurance: life insurance, fire insurance, marine insurance, and the health insurance. Life insurance is related to the two types of risks: risks of dying too early, risks of dying too late. Generally, life insurance policy, when they have to fear of dying too early, then to provide financial support to their family, they take life insurance policy. Sometimes people take life insurance policy to get financial support and economic independence during their old age. When people think of living too late, then to get some financial support during old age. Also, the insurance policy is taken. If the life insurance dies early, his family get compensation amount. If a person survives, then he or she himself or herself can get the policy amount. In life insurance, the insured has to pay a fixed amount of premium, and in return the compensation is assured at the death, at the time of death of a person, at the time of the maturity period, whichever comes earlier. For fixing the amount, the insurance companies rely on the statistics of the mortality. Mortality means the death, and morbidity means illness. It is hard to predict when a person will die, so insurance company rely on the statistical data for fixing the amount of premium. In the life insurance contract, the premium can be paid monthly, quarterly, and the yearly, as the insurers pays the policy amount at the death or on the expiry of the specific time period, which is also called the maturity time of the policy. Kinds of the insurance policy: whole life policy, endowment life policy, joint life policy, and the annuity policy. The whole life policy: under this policy, the insured sum is paid only on the death of the insured. It means the policy is to run for the whole life of assured. In life insurance, insured is called assured. The premium on the policy is paid for a fixed period of time, say 20 or 30 years, but the sum assured is paid to the beneficiary only at the time of death. If premium is also paid for whole life, then it is called whole life policy. Endowment life policy: under this policy, the insurer pays particular sum at the time of death of the person, or on attaining a particular age, or an expiry of fixed period of time, whichever comes earlier. In case of death, the compensation is paid to the legal heirs of the deceased person. In case of he survives, then assured himself get compensation amount. Apart from these two categories, the assurance policy, the life, I'm not talking about the life insurance policy, but about the life assurance policy, which assure to the end of the life. There are various kinds of the life insurance policy offered by the various companies, such as LIC, Jeevan Mitra, Jeevan Sathi, Money Back Policy, Jeevan Surbhi, Bima Sandesh, and the Jeevan Kishore. There are so many policies which are issued by the companies, by the LIC. Joint life policy: this policy is taken up by the two or more persons. The premium is paid jointly or by either of them, just like the husband and wife who take this policy. The annuity policy: under this policy, the assured sum of policy money is payable after monthly, quarterly, half-yearly, or annual installment. Tomorrow we will discuss about the fire insurance, marine insurance, and the health insurance. Today we have been discussed about the life insurance policy. What was that? How many types of policies are there who protect the people for their lives? Tomorrow we'll go for the another points. That's all for the day. Thank you. Have a nice day.